Today, we will analyze Healthpeak with a ticker symbol DOC. This healthcare REIT has 6% dividend yield while growing at a 12% per year. In addition, the management recently launched a buyback program, and obviously, these are pretty good combination for the shareholders. The company was founded in 1985 and currently has about $14 billion of market cap. Let's start with its business model. From 2016 to 19, Healthpeak had four main operating segments, with the shop business, which is a senior housing business that we discussed in detail in the previous video, contributing most of the revenue. However, starting in 2017, Healthpeak decided to decrease its exposure to this shop business. And since then, DOC constantly sold its shop assets that were old and had low occupancy rates, strategically shifting its focus to life sciences and outpatient medical properties. So currently, DOC divides its properties into three asset types. The first segment is similar to traditional office rental business, but the difference is Healthpeak's focus on healthcare providers with 98% affiliated with hospital system. This segment contributes about 35% of total revenue. Second, Healthpeak owns laboratories and office spaces primarily leased to technology and research institutions. This lab segment contributes about 40% of DOC's total revenue. Lastly, the CCRC segment generates revenue by providing integrated healthcare services to the elderly. Unlike other segments, CCRC operates the assets with third-party partners. So like the Ventas that we discussed before, it's more exposed to the ups and downs of the senior housing properties. And this segment contributes about 25% of the revenue. Now, let's check DOC's historical performance in terms of stock price, profits, and dividends. Similar to other US REITs, Healthpeak had sudden and negative impact from the COVID. However, while other US REITs have recovered, DOC has failed to return to pre-COVID level. But if we look at the revenue, it significantly declined during 2017 to 18. But afterwards, even during the COVID, DOC's revenue is increasing at a healthy pace. And if we look at the profit margins of each segment, the CCRC business has a low profit margin, but the other two segments has higher margins because they are just renting out the assets. So for the overall profit margins, there were ups and downs with business mix shifts. But since the business mix stabilized in the recent 3 years, the combined profit margin also stabilized. So if we combine this stabilized margin with the increasing revenue that we saw before, DOC was able to increase its FFO per share by 12% per year for the past 3 years. Looking at the dividend trend, as the company went through restructuring in the past, it decreased its dividends. However, after the restructuring, the dividend has been stable for the past 4 years. Since dividend stayed stable while the profit increased, the management spent its money to grow its assets through M&A. For example, in March of 2024, company acquired Physicians Realty Trust and increased its exposure to the outpatient segment. So when we analyze the market trend of these REITs, we will focus on this outpatient segment, which will contribute most of the revenue in the future. As we can see here, the overall spending on healthcare in the US is expected to grow at a healthy pace. But more importantly, the outpatient segment is increasing at a much faster rate. And while this demand is increasing, the supply of outpatient hospitals is restricted because of increase of construction costs. So as we can see here, supply of new hospitals is limited in recent years. And this positive trend is expected to continue because as we saw before, the elderly population in US is expected to grow as baby boomers enter into this age group. As people get older, their trips to hospitals and also the money they spend per year dramatically increase. So overall, the market trend for outpatient segment is very positive. With this in mind, let's move on to the operating status of DOC. First, the occupancy rate overall is pretty stable, and the CCRC business, which suffered during the COVID era, is recovering from the downturn. And looking at the top tenants, it's pretty well spread out, except that the number one tenant, the HCA Healthcare, contributes about 8 to 9% of the total revenue. And if you look at the leases expiration schedule, it's pretty well spread out for the next 10 years. When we look at the property locations, it seems like San Francisco and Boston area has high concentration. This is mainly because the biotech companies are located in those areas. However, if we consider other assets, it's pretty well spread out across the US. Moving on to payout ratio, current 65% is much lower than the healthcare peer. So DOC's dividend stability is quite high. So if we summarize the data that we looked at so far, DOC's operating status is quite solid. And now let's move on to the financial risks. First, in terms of the debt level, when the company went through restructuring, the total debt level decreased as low as $5.5 billion in 2018. However, as the company acquired more assets, especially in March of 2024, the debt level increased again to $8.9 billion. But looking at the debt to EBITDA multiple, DOC's current 6.4 times multiple is in line with the equity REITs average. So DOC is enjoying BBB plus and Baa1 credit ratings, and thanks to the management savvy, the effective interest rate for this company is only at 3.3%, which is lower than the US Treasury rate at the moment. And the payout schedule for the debt is also well spread out into the future. So overall, the company manages its debt quite well, and the financial safety seems pretty high for this company. Now let's move on to the pros and cons. First, as we saw before, the supply and demand for healthcare sector, especially the outpatient business, is quite positive for DOC. And the management is also taking advantage of this by buying back the shares. And this is also related to the third positive factor. For example, during the earnings call, the management mentioned that they are willing to sell shop business if the price seems right. As we can see in this statement, and also the buyback that the management is doing right now, we can see that the management is conscious of the value and price dynamic. So basically, the company is not going to waste its money so easily. Moving on to the negatives, the poor historical performance is definitely a disappointing factor. Second, the high exposure to HCA healthcare, the number one tenant, can also be considered a risk factor. Finally, let's move on to the valuation at current price level. When I invest in dividend stocks, my target dividend yield is about 6.5%. However, DOC's current dividend yield is only 6%. But we need to take account that the management is also doing buybacks. So if we translate that amount into percentage, DOC is currently returning above 7% for the shareholders. So in this regard, it fits my first checklist. And looking at its historical multiples, if we look at the past 13 years, current 16.5 times multiple suggests that it's at a good price. However, if we increase this timeline to more than 20 years, current 6.5 times is not as high compared to just looking at the past few years. So in terms of the multiple, DOC stock price needs to fall further in order to be considered a bargain purchase. So this wraps up the analysis of DOC, and I will see you guys again in the next REITs analysis. Thanks guys.